Thank you for joining me. I'm Julie Farrell with Directors Mortgage, and Julie does loans, and I have Noah Blanton here with WFG, President of the Oregon WFG.
Yes, yeah. It's wonderful to be here.
Thank you
Thanks
so much
for inviting
joining me. Well, I love chatting with you. You have a tremendous amount of insight on our local marketplace, as well as a great way to disseminate the information to consumers and make it really relatable. So I enjoy that perspective. And we had the opportunity to have lunch not too long ago, and we were talking about the question that I get asked all the time, which you get asked all the time.
It's got to be one of two, so go ahead.
Yes, one of two. Are we on the brink of the next housing bubble? And you had some really interesting perspectives on this.
I mean, the short answer for me is no. And I think you have to, as we talked, separate those two things out into, has there been, tremendous appreciation in the last 12 to 18 months? Yes. I mean, is it outside of, generally what we experience? Yes. But I think you have to look at the reasons underneath that. If you're going to ask yourself, is there a bubble? The proverbial, is there a bubble? Is it about to pop and I'm going to get my home for 20% less than people are paying today? And on that question, I think no. And I'll outline some of the reasons why I think that's the case. Because I also don't think it's an unreasonable question, by the way. Because, people have been like, well, we appreciated 18%. I mean, the price of a home in the metro area has doubled in 10 years.
Right.
That feels like, a tremendous run-up in the price of a home. And it's true, it is. So I don't think it's an unreasonable question to ask. I just think, our context largely for asking that question is 2008. Mm-hmm. And that's where I think we, the two bubbles, if you will, diverge. And I don't think this one's a bubble. Now, nationally, that might be a little bit different. Nationally, is real estate potentially overvalued in some places? Yes. I mean, I think that's true. Here in the Portland metro area, I don't think that's true, and I'll tell you why. I mean, it ends up coming out as just some sort of simple supply demand things. So talking points on supply and demand. So this housing market was created by the last housing market, and I think it's important to look at the long-term, marketplace. And we stopped building was one of the things we did when out of the last recession and housing bubble, centered around, housing finance. I think that's a key. That recession was centered around finance, housing finance, and some probably pretty poor lending practices. That's well documented. Those don't exist. So, I mean, that's, I think, component number one. That doesn't exist.
Thank you for highlighting that.
Yeah, I mean, it just doesn't. And, that's something that is provable. We don't have to wonder, does it or does it not? So that's number one. Number two is we did not build at any scale for the last decade. We really haven't. And so if you start looking at, we're talking about now, let's talk about single family, residential homes. We're not even building at the same rate we were in the early to mid 90s. So we're still not back to that place. So for a number of different reasons, it's expensive. Our land use policies, we don't have the same land to build at scale as other places. And there's a caution there. Builders aren't going to, they remember it was tough. And anybody that went through that period of time, you're not going to put yourself in that position again. So we've underbuilt for a decade, largely. Right. We had a huge run-up in population. Let's say 250,000 more people came in the last 8 to 10 years, probably a little more. And what we did was we built multifamily. And so I've sort of always said, okay, how did we meet the demand? Right after the recession, it was with distressed housing inventory. We had a tremendous amount of it. It was relatively cheap at the time. And that's where we met, the demand for housing. And then when we got out of that recession, we largely, as we started to grow, if you look at the supply we put into the market, it was, for the first time ever, 50 or 60% multifamily. So we put, hundreds of thousands of multifamily units into the metro area, and we filled them up. They're 3 and 4% vacant prior to the pandemic. But we didn't build, at any significant scale. There isn't significant spec inventory. I mean, the way we've approached building has fundamentally changed, I think, at least in the Northwest. So we don't have this huge supply that can come and oversupply the market. And then I think the last 2 years, and I know this is a long, rambling answer, but it's a big question, and I think it deserves, looking at a lot of the different data points. The other one is we've tremendously, rates are a double-edged sword, and I'm sure we'll talk about rates, but you have this double-edged sword of a tremendous disincentive to people who've refinanced their home at a sub 3% interest rate. And we now sort of have this problem, and California had this problem in certain areas as well, where if you're buying and selling into the same market, there isn't a tremendous amount of opportunity for arbitrage unless you're, let's say, switching product type. So if you're buying, if you're selling a suburban home and today leveraging into, principal urban centers, you probably have some opportunity to sell high and maybe buy a little bit low, we'll say. But I just don't think that we have the inventory that's going to come to the market, and I think that existing inventory, so new inventory and then existing, we've disincentivized sellers. Their house is worth $200,000 more than it was 2 years ago. They got a sub 2% rate, and even if they wanted to move within the market, some of them are like, I can't afford it. I can't afford to buy the home in that I live in today. So there is that, in a short span of time, record low interest rates, record high appreciation. It disincentivizes sellers to engage in the market if they're going to stay. Excuse me. So for all of those reasons, supply we're not going to oversupply our market. And you and I, probably the secondary question that we get asked is, but there's a truckload of foreclosures coming too.
Yes.
That isn't true. That just simply isn't true. There's probably more concern from my perspective on what happens when eviction moratoriums end and how landlords are going to deal with that. From a multifamily perspective,
completely agree with you
that's
there.
a totally different conversation. Mm-hmm. And there's no, and I've talked to several landlords and property managers, and there's no standard way of dealing with it. I mean,
Well, and the numbers are staggering. Over 80% of those that took advantage of forbearance on single-family residential mortgages are out of that forbearance and have a plan in place.
Right.
So we're talking about 20% of the consumers that took advantage of that program that still need to figure out a way to make that work. And a lot of them are going to either be able to sell because of those tremendous gains in equity.
Right.
Or they'll be able to work out some sort of plan, again, because of those tremendous gains in equity. We're not going to see that.
And that, excuse me, that is, by the way, some tiny percentage of the people that went into forbearance. I mean, to your point, we know the 80% and how they're exiting. We see that data. And then the loans in default, I think the last survey I saw was less than 3% now nationwide.
Yes. Yeah.
And in the Portland metro area, I think it's 0.4% of homes greater at 30 to 90 days late. So there isn't a large backlog of people that can't make their payment. And so, there's just a tremendous amount of information around this. One of the other things that ended up happening is the pandemic didn't hit the earning power of people that own homes largely. When we look at the, quartiles or quintiles of people who were able to maintain or increase their income during the pandemic, who was impacted and couldn't make their payments, it wasn't those folks largely that were able to own homes. And I think this speaks to some of the counterintuitive thinking about, the recession that we went through, the brief one, the pandemic. I promise if you and I were talking in March of 2020, I was not about to predict real estate's about to have its best 2 years ever. That would not have been my prediction. I would have said something more like, I have no idea what the hell's going to happen. I have no idea how people are going to react. I don't know how the job market is going to react. We were shut down largely for some number of weeks. No economic activity was happening. The expectation was not a rebound to the highest levels of appreciation we've ever experienced and record high demand. So on the supply side, we're not overbuilding. We don't have a glut of foreclosures coming. Even those that may need to sell their home will be able to sell it and put money in their pocket because of the tremendous gains in equity. Outstanding, certainly is multifamily residential. And I do worry a little bit about that just because of the demographics, because if landlords start to heavily incent or discount their product, it will make renting look attractive. I mean, people don't generally tend to think about a multifamily residential project and a single family home as competition, but it's all competition for housing. And if you're able to say, well, geez, I just got 4 months whacked off my rent and I'm guaranteed no increases for the next 18 months, you might think twice about do I want to engage in a housing market that is pretty competitive. Mm-hmm. So I think that could have a little bit of an impact, and maybe greater than we actually think. So the demand side, is easy. We have one of the, and I'll tell you where I think the risk is, but we have one of the absolute best sets of demographics in the country for household formation and home ownership demand over the next 3 to 5 years. So we have a cohort of people that are, I think, 25 to 54 years old. That's peak housing expenditure and household formation, peak household formation years, and it's almost 1 million people. And it's, I think, I want to say if you couple all of those people together, it's over 50% of if you add them all up, it's some number in the 50% range. 30% range of our entire population. A third fits in there. So we have to remember all of these tens of thousands of people that moved here and went into multifamily. We need to look at their demographics. They're going to start forming households. Those generations want to own real estate. I mean, we know that's true. So we have nice, healthy built-in demand as well as migratory pressures, south to north, where there's still a lot of people that want to be here. And so I don't see a demand side issue where that would fall off, and I don't see us getting out over our skis from a supply perspective. Builders are well checked. There's a disincentive for existing inventory to come to the market. Low rates have ensured that. We're not going to have significant foreclosures. So I think it feels like there is a bubble because there's been tremendous appreciation, but none of the underlying fundamentals from my perspective would indicate that's the case. So will there be a slowing of appreciation? I sure hope so. Yeah. I mean, do I think a 12 to 18% rate of appreciation is any healthier than a 15% decline in the value? No, I don't.
Right. And it's not sustainable.
No, and we shouldn't want it to be, because it'll push a lot of people that have a desire to own homes out of that space. So would I be happy with 3 to 5%? Yeah, I would be thrilled. Will that feel like maybe apocalyptic to a seller? Maybe, but I think there's some room for some deceleration in the appreciation, the rate of appreciation. But we'll see. I'm sure we'll talk more about that as well.
So rates for the remainder of this year have been coming up, and they've gotten rather interesting lately, because I was really on the forecast where their inflation is inevitable, rates going up are inevitable, and it is happening, people. Yeah. And now here I am eating a little bit of crow. Yeah. Which is great for my clients. Yeah. And for anyone looking for a residential mortgage. But what are your forecasts for the remainder of this year, for 2021?
Okay. So for the next, let's say, 2 months, I hesitate to even say this. I think they're going down. But I have been a long-term proponent of downward trajectory in rates. I think they're going to continue going down, quite frankly. And they've been falling for 45 years. Borrowing costs have been falling for 45 years. And I have yet to really hear a compelling argument from somebody other than, well, they just have to go back up, as a reason as to why they would go back up. So, and I know this is a really big conversation. Yeah. Okay, yeah. So I guess in the very short, the short answer is I think there's some room for them to retreat into the end of the year, and that gets into a big conversation around the influence and effect of inflation and the even the Fed's own tapering programs as it relates to mortgage rates and mortgage-backed securities, and so it's a big conversation around that, and I'm sure there's a good argument to be made for why they're going up, especially with inflation, where it's at. But I'm a little bit more practical, I guess, in terms of they cannot go up any significant amount and there still be velocity of transaction. And so I think we have to look at, and you know this better than anybody. You have an interest rate, you have the cost of the product, whatever that product is, but the biggest limiting factor is really the borrower's income, and the influence that those two things have on the borrower's ability to qualify for whatever it is they'd like to buy. And I think we're in a situation where I do think there's some risk to, year over year, tremendous rates of appreciation and rising rates. But I think it's a little bit more fundamental than that, in that I personally just don't think that the growth is as sustainable in terms of GDP as we think it is. And I think there's a lot of underlying noise in that's going to shape out over the next couple of months. We've had great corporate earnings, so of course that that influences. But those are past earnings; those aren't present or future earnings, and it's not where the direction of where things are going at the moment. So I think there is room for them to go down, and I would be even a little bit more bold to say I think we will see rates back in the 2% range next year.
Next year.
I'm being bold on that because everybody likes to sort of couch their interest rate forecasts and say, well, it could be, you're right, they could go up. I just am not sure I see that in the long run. And people will always say to me, well, they have to go up. They just have to. They have to go back to a normal rate. What is the magic normal rate? And normally the normal rate is the one that whoever you're speaking to happens to be slightly uncomfortable with. And they'll be like, well, this rate, because I'm slightly uncomfortable with that rate. And then other people will say, well, you can't have rates going down long term in a large economy like ours. And I don't know, the Japanese have done just fine with it. They've been decreasing rates for the same amount of time as we have. Our rates have been going down for 45 years. And they go down like this. Right. It's not a straight down line. So we may experience periods where, brief periods where they do go up. But I also psychologically think that we are more in tune to the impact of rates now because we have hit all-time lows. So, and you probably have better perspective on this than I do, but the consumer is extremely rate sensitive. From our perspective right now, and
absolutely,
you might speak to that even more. And so there's this almost, doubling of actual action taken when rates go up as opposed to when rates go down, because the way we consume psychologically, we're doubly afraid of loss than we are of potential gain. And so when we say, rates are going up, well, I'm not going to do anything. There's a staggering number of people who still could benefit from lowering their interest rate, especially if they're going to stay on their home or converting to some other type of product than a traditional 30-year mortgage that just don't.
Cash out refinances are back.
Yeah.
And make sense again.
Yep.
It's not just in case of emergency situations.
Yep.
It's debt consolidation. It's reallocating your assets and maybe pulling cash out to invest in annuities. It is long-term planning that I've not witnessed before in my career, and I've been doing this for 20 years.
Yeah.
But the appreciation is being used in different ways with cash out refinances. And they need to be. There's still tremendous equity in the property. It's not the cash out refinance of 2005 through 7
for the boat,
right? Or the vacation, or to get caught up on your mortgage refinance. It's not those.
Yeah.
Okay.
So I'm giving you a really I'm giving you a really long-winded answer to why I don't think rates are going up. So let me be a little bit more specific. I don't think our growth, when I look a little bit underneath, I don't think our growth is as strong as we think it is. I think I am less concerned about, just in the short term, I'm less concerned about inflation due to supply chain issues, and we can talk about that if you want to. I'm more concerned about energy. That's a longer term sort of inflationary thing that I would be worried about. But I think the other thing I think about interest rates is, and this is probably more of a, it's probably more of an intellectual discussion, but we have gotten very, in the old days, let's go back, 30 or 40 years. You had a pool of money that was lent by a very small group of people, controlled, let's say, by financial institutions. And they lent that money, in a wide range of ways, everything from auto loans to home loans to, business loans to other types of things. And we weren't very good at segmenting or segregating risk inside of a lending pool. Well, we're very good at that today. We are quite good at saying this is a venture capital fund and you pay 22% interest there because it's very risky. And we don't have that risk inside of a traditional financial institution. And this is a commercial bank, and they lend in this space with certain restrictions. And this is this type of financial institution. This is a private hedge fund. And then we have, traditional mortgage lenders whose capital is collateralized and very stable, and it's not always subject to other forms of risk. So we've gotten really good at segmenting risk. And I guess a part of me would also just argue that the long run cost of capital is accurately reflected in interest rates today based on risk.
Right.
Because an interest rate's a risk premium. And you're in a pretty good position if you're getting, based on some of the other debt you could buy, 2.5% to 3.5% on a collateralized piece of property that's increasing in value by 12 to 18% every year. So
it's a solid risk.
Yeah, it's a pretty solid risk, and if it's segregated or segmented there, and it's not sort of subject to other potential systemic risk that might come in and take you down. That was the 2008 financial crisis, essentially, was all of the systemic risk associated. So I think we've gotten good at segmenting where risk is, and I think a 30-year mortgage-backed security is a pretty low risk with a pretty high collateralization behind it. So if you look at all the forms of potentially risky investments you can make, that one I think will continue, as it always has been, a pretty low risk. So I there's a lot of reasons, and we could probably talk for hours around it, but I just don't think rates are going up in the long run. And for the next couple of months, I think there's actually tremendous opportunity for them to drop. So that's my thought. And I think we will be back in the twos next year. Maybe I'm wrong. I could be wrong. But some of the forecasts that I follow have us, let's go out a very long range forecast, and this is almost meaningless at this point in time, but there are these very long range forecasts, and I can't find any very long range, and I'm going to say very long range is 3 to 5 years, that don't dip back down into the twos. Most of the long range forecasts. And they actually, the Financial Forecast Center that I follow quite a bit has them going below 2.5% in the next 3 to 5 years. So, and there are, and I'm not saying this to be, alarmist by any stretch of the imagination, but there are some folks already that are saying the U.S. is in recession, and that we will figure that out at the end of the next quarter. And I don't think that is necessarily a scary thing.
I completely agree.
At all.
However, you say that word,
I know,
and it sends shudders. Around.
I know, but I think we have to contextualize the word.
Exactly.
Okay, in the last 2 years, we have gone from the greatest recession that we've ever had at any point in time in history to the greatest rebound we've ever had. Much of that has been driven not by economic desire or activity or capacity. In fact, almost none of it was. It was driven by a global pandemic, the shutdown of society at differing levels, a figuring out and understanding what this meant, But if you look at the GDP chart, it's ridiculous. And so I think there's some ping-ponging that will happen as we get back to sort of a long-run, natural, whatever our rate of GDP is. So I don't think it would be unusual for us to go into a slight recession, simply defined as a drop in GDP for 2 consecutive quarters. It's not, and that may be as long as it lasts.
Exactly.
It may not go any longer than that. I mean, we just went through the briefest recession I think we've ever had.
Right. It's a defining term
Yeah.
of state of the market.
Yeah.
Not necessarily indicative of doom and gloom.
Correct. Yeah. So that's important to say that. But my point around that being, generally you would see interest rates rising as a way to pull back some economic activity. And the other thing that, just candidly, I don't think we've fully worked out yet is what our interest rate or market environment looks like with the trillions and trillions of extra dollars we have dumped into the economy over the last 24 months. And we've been doing it at a pretty steady clip no matter what for the past 16 years or so. We accelerated that to buy ourselves out of pandemic. Whether that's a good idea or a bad idea, I guess ultimately we'll end up seeing. But I'm not entirely convinced that all of this money is in the hands of consumers, for one, that want or need to spend it, for two. Has there been some catch-up spending? Yeah, no question. And the supply chain issues exacerbate those. I mean, I feel sorry for anybody who's had to buy a car in the last 12 months because you sort of feel that. I mean, it's quite rare when you go to turn your lease in and they say the car is worth $8,000 more than your payoff value. Not my car, unfortunately, but other people's.
You hear stories.
Yeah, I have heard. So there's just a lot of noise around whether or not, in my reading and just what I look at, I'm not convinced that we have very long-term inflation. In energy, yes, I think we do. But that's, I would largely say, our own fault. It's not a supply and demand issue that is naturally occurring. It's one that we helped occur. Everybody has a different opinion on whether that's a good or a bad thing, but energy makes everything more expensive. And so we'll see. I could be wrong. I could be wrong, but I think they have the potential to go down. What do you think?
Well, for a lot of those same reasons. However, I hadn't even considered the energy portion of things, so that's interesting that you bring that to light. I think that consumer confidence plays a huge role in whether or not they're open to spending.
Yeah.
You bring up the great point of folks have refinanced into fantastic interest rates. Why would they leave their home? And what I'm finding, a lot of the people that are applying for mortgages that are in great economic situations to where it makes sense to invest more in real estate, they're looking at purchasing a second home.
Yeah.
They're keeping their primary residence at that killer interest rate. And they may or may not convert the second home to a primary residence, but a lot of them are purchasing homes in areas that they either want to be in long term or vacation in. So Central Oregon, the coast, Arizona, and they're trying it on for size. They're going to lease out their primary residence or turn the other one into an Airbnb. Yeah. And I just think that buying now is completely different than I would have forecasted in March of 2020. Yeah. That's for sure.
Yeah, and who knew that home and housing would take on such a different meaning? I mean, a place where we spend now, many of us, a lot more time than we used to. We work there a lot more. We travel less generally, or we have. And that's a second element of demand that we really didn't talk about, which was second homes. Mm-hmm. And the fact that there is probably some demand implied in markets that is not coming from within the market, that are people doing, in fact, what you're saying, and especially probably in places like Bend and Arizona and places that I think Nevada is another place where a lot of that is occurring. And you're competing with people who may not necessarily even be in your market. They may be, depending on what the product is, buying from another market. And so, now you have one consumer demand in two markets. I don't know that we really have any way of capturing what that looks like. We capture demand through household formation and demographics and population growth. I'm not aware of sort of capturing what do people want, from like a second home perspective. And as you said, the tremendous amount of this happening, people saying, I might want to live here, so I'm going to buy a house there, and I'm going to spend time there, and I'm going to see if it's what I want. Mm-hmm. And I have the ability to, because I can work from there now. Mm-hmm. Yeah. I think that's very exciting.
It is.
Because it's giving people options that they didn't have before and allowing them to make moves in their life that are best for them. I love that piece of what's come out of this.
Me too. I'm also seeing more of a movement to multiple family members, multi-generational housing. And I know a lot of my peers are seeing this as well. Families are purchasing much higher than what they anticipated because they can't quite get into what they want at the price point that they can qualify for. So they blend mom, dad, kids, grandkids, and
anecdotally, I have watched new construction move that direction as well, where you'll see a lot more, the house just comes with an ADU, or it comes with two masters, one of which is on the main, set up for intergenerational type living. And the market's clever. Maybe, as you mentioned, people are doing that because it's like, well, I can afford $650, but what I really need is $910. But if we all go in on this together, we'll
Well, and I'm seeing that. I see the applications.
Yeah.
So I see it on the front end and the second home applications, the investment property applications. Even though investment property interest rates are higher than the twos, that is still such a low cost for an investment property. And your ability to see those gains year over year on equity and see the rental come in, it cash flows really nicely right now.
And there's some tremendous tax benefits, and it's a great inflation hedge if inflation actually is here. I mean, so there, I think maybe that would accelerate if inflation really is here for the long run. We'll see. I think the longshoremen are going to fix it, though. I think they're working 24 hours a day now. I think we worked through some of the issues there. So
the supply chain issues.
Yeah. No, nobody is, and long term, by the way, and this is probably not appropriate for this conversation, but long term, I think that the supply chain issues will change local economies and global relationships. I mean, I think there's this growing, realization that the supply chains were built for efficiency, not for robustness, and they were very efficient but delicate, and they absolutely maximized profits with JIT manufacturing and stocking, but they weren't very robust, and so we see them break, and you see a few ports that are able to bottleneck things for an entire country, and you realize how delicate they are. So long term, I mean, there will be some changes in things like nearshoring and changing where manufacturing is done, where you have control over it. But it's probably also the reason industrial and warehouse land is through the roof, because I think there's going to be some changes in long term how business manages the supply chain, and that could have really positive economic benefits for domestic markets. So that's a long term sort of.
But that evolution is what's fascinating and what creates the economy that we live in.
Yeah.
So this is exactly what we're here to talk about.
Yeah. Well, and the opportunity. So, somebody can call me and argue with me about interest rates. That's okay.
Hey, it's just our best hypothesis.
And I'm not, by the way, I'm not I'm not an ostrich here. I mean, I don't have my head in the sand. I recognize there is tremendous inflation at present. I recognize energy's up 40%. I recognize, a mattress is up 17% or whatever. I do recognize that. I have not reconciled for myself yet whether I think that is because there is the inability to meet the demands of the consumer who has so much money that they want to spend and can't find a place to spend it, so they're driving up prices. I can clearly see that relationship in real estate, over the last 20 months. I can't as clearly see that in a broad range of consumer spending, I guess. Some of it's constrained supply, but when you look at, luxury goods as a for instance, you look at companies like LVMH or companies like that's discretionary consumer spending, not really what I would, certainly not core consumer spending. And are people spending money on, at Tiffany's, because they have discretionary income? That's not a long-term inflationary, prospect.
Excellent example, by the way.
Yeah, they're not going to say, I, am now going to buy a Tiffany piece of jewelry every month. No, they're not. They might make one or two purchases that otherwise they would not have made. But that's not a long-term sort of. So that, I guess, if there's a way for me to explain, how I'm looking
I think you've done it beautifully.
At inflation differently.
Housing is a very different purchase than Tiffany's, than jewelry, although highly appreciated.
Yeah, well, I'm not recommending against it.
but there's a lot of feelings that go into a housing purchase, and the majority of housing is, of course, primary housing, not necessarily business type housing. So,
and we have this anxiety around, the other question that you're asked generally, that I'm asked right after, we're in a housing bubble, this thing's about to pop, and I'm going to clean up by just scooping up all this real estate that's worth 50% less. But the other one is always, is it a good time to buy? That's always the question. And you and I have talked enough about this that I just don't think trying to time the buy of a primary residence is a great idea. And I know emotionally we want to. If you need to move in a year, yes, you should probably be trying to time your buy. But if you're buying a home and you're going to use it and you're going to live in it, it has utility for you. It's not people hate it when I say this, it's not an investment, it's an asset. An investment, provides you a stream of cash flows, and an asset does not. So when people say I'm investing in gold, no, you're hedging with gold. It doesn't, So it's, in my mind, it's an asset, but not an investment. And it's hopefully an asset that has utility to you. You get to live in it. You get to, have some tax benefits from it, and all of this. And then you sell it, and hopefully it's gone up in value over time. And it's been proved that it does. But I think you should buy a home when you need one, and be comfortable and confident that in the long run, real estate always appreciates. And every single one of us, I know both of us sitting at this table here, wished we had bought real estate in 2008, 9, and 10. Right at the time when everyone said it was the worst time to buy real estate and people never wanted to own real estate again. And I try to have a long enough memory. I have saved many articles from professional writers on real estate who were declaring that real estate was dead and people had changed what they wanted forever. And, millennials didn't want to own homes anymore because they realized that was stupid, and they were going to, live in communal areas and share kitchens and bathrooms. And none of that turned out to be true. As it turns out, people still want to own real estate, still want to have a home. So I'm not a big proponent of trying to, time your buy correctly. Selling's a different conversation, and that gets into, well, what are your goals after selling? But I'm not a big one for trying to time a buy. Buy it when you need it.
I share that same sentiment. I get asked frequently, you're right, but I often get asked, is it a good time to buy?
Yeah.
I hear it's a terrible market to buy in.
Yeah.
I'm usually told, not asked, I'm told it's a terrible market to buy in.
Yeah.
And, I think you have to work with experts, certainly. It's very tough to navigate on your own. However, there are certain strategies that you can implement to make the purchase go more smoothly and a little bit more to your expectations.
Yeah.
But oftentimes buyers are seeking a deal.
Yeah.
And the deal is the interest rate right
now.
It's not the price of the home.
Yeah.
And once they really wrap their brain around that, it becomes a little bit of an easier conversation, because oftentimes buyers will want to come in at still a lower, their first offers at least, at a lower purchase price than list.
Yeah.
Because they want to get the deal.
Yeah. So it's interesting. I'm going to tell you a story about that, but I'm going to say two things first. Asking if it's a good market to buy in is always, to me, kind of asking, like, is it a good time to plant a tree? It's like, yes, that's when it will start to grow, is when you plant it. And was 3 years ago a better time to buy? Or plant a tree, for that matter? Maybe. I don't know. But, I mean, if you have the tree, plant the damn thing. So I always think it's a trick question, because it's like, if you need it, you buy it. But the second question I always generally ask is, do you plan on not spending money on housing? Well, no, I still have to spend money on housing. Okay, by far your best option then is buying a house, regardless of what the market is, unless you plan on spending no money on housing, and then you're very lucky, and maybe it's not a good time to buy for you. But it's interesting on the buyer side, and this is where I think there is actually still quite a bit of pent-up buyer demand in our market based on our demographics, and then I think also the behavior of prices over the last 18 months or so. There is in our minds right now, and I kind of want to dispel this idea that we've experienced 2 to 3 years of just runaway appreciation in housing. And I want to be really clear, the vast majority of appreciation in housing has happened in the last 9 months. Mm-hmm. And the vast majority of that appreciation happened inside of 3 months during the summer.
Right.
So I think that's really important when we talk about, is there going to be a deflationary event in real estate? I think you have to also put that into context and say, well, you might want to cut out these 3 months that are, a real outlier, and draw your appreciation line removing those couple of months. So in 2 months this year, it was July and August, the average price over asking got nearly to 106%. In January, it was 100%. And if we go back to January of 2020, it was, I think, 99%. So at 100 or high 90%, we would say this is a market in balance. Buyers and sellers agree on the price, and that's generally where we would like to see it. If you break that down further by price quintile, certainly, intuitively, you would say, well, yes, the lowest price quintile increased the most. It did. That's true. And then the second to lowest increased the second most. That one's important because it contains the median price. But those were nearing 106%. And in January and February of this year, the average amount paid over asking price over all transactions was $12. In July and August, the average price paid over asking was nearly $30,000 across all price points. Sellers took home $150 million more than they had asked for in those 2 months alone.
Wow.
Just those 2 months, they put $150 million more than they had asked buyers to pay for their house in just those 2 months. August, we saw a decline. September, we saw a decline. October, we see a decline. The largest decline is in the highest price point. That makes sense. But all price categories and the blended price category have now hit their high. We've gone through our mini cycle of seasonality, and we're coming off of that now, and all price points are coming back down. They're still above 100%, but closer to 100%. I think the last month we measured, it was, poor sellers were only getting like $15,000 on average over what they were asking.
And the average days on market went up by 2 or 3 days.
Yeah, it's gone up, I think, for the last 90 or 120 days.
It has, but still.
But that goes back to the earlier conversation around consumer sensitivity to, they can recognize and contextualize a trend that is in their favor, but not one they perceive to not be in their favor.
Absolutely.
And often will not take the action they should take because the signals they're getting are ones that they're either listening to or interpreting incorrectly. And I wrote a piece the other day that said, of this year, the fourth quarter is probably the best time for you to buy a home. And the earlier you do it in the fourth quarter, the better, because our supply-demand imbalance tends to be at its absolute worst point in December. So this goes back to your conversation around working with professionals and asking questions and letting those people that are engaged in this business contextualize the business for you, give you information that you may not be getting elsewhere, and then you can make a decision about whether it's a good time based on your individual situation. But I think there's a lot of people who are incorrectly guessing this market to be one that's going to have a downside to it, a big one. And that is just, there is no fundamental that would indicate that's going to happen in our marketplace. So, and honestly, I think the biggest threat to that is interest rates. That will devalue property because it has to, going back to the point around what borrowers can afford. And you can speak to this. It would have to go up quite a bit at this point, I think, to materially impact a buyer being able to actually, push them out of being able to buy a home. I mean, how much would it have to go up?
Well,
or am I wrong on that?
It depends entirely on everything.
Yeah.
I mean, it really does.
All right, stupid question.
Well, not a stupid question, and but that is the question. How much of a difference will it make in what I qualify for if rates go up by a 0.25 percentage point?
Right.
Well, it can make a big difference. And so I don't have fast answers on what it looks like because it depends on so many different
maybe
factors.
The broader point is there's two levers to pull. Real estate isn't overly complicated. There's rate, there's price, and there's borrower income. And that's a great simplification, but I think it's a good one because those things all interplay to how much demand can there be in a market. We could be growing our population by 20% every year, and if they couldn't afford to buy homes, it would have zero impact on, it would have a great impact on housing, but very little impact on demand for homes. So I just think it's important to keep those three factors in place. And so if interest rates are going to go up to 4.5%, it would be silly to say that's not going to in some way devalue real estate at certain price points.
It absolutely will.
Yep.
And here's where it will. Those buyers, as they're looking at their maximum price point, they're not going to be able to offer 106%.
Right.
They can only offer 100%.
Right.
And so that's where it really comes into play is when consumers are at their maximum.
But here's the thing for me that always sort of gets me is, and yet the buyer's going to pay the same monthly payment either way. So, I mean, generally their payment is going to be the same either way. Right. And so I think sellers also need to think about that as it's not, it's not that your property is less valuable, it's less affordable. I would be more concerned about affordability than value as it relates to interest rates because
I could just hug you right now because that's it. It's about affordability.
Yep.
And maybe the interest rate is going to come at a little bit of a cost.
Yep.
To get that rate below 3% that you so desperately want.
Yep.
Pay the cost, get the rate. We can make it happen for you, but you're either going to pay for it in the housing expense, purchase price, or in the interest rate. You can there's all sorts of ways that you can make this affordable for you.
Yeah. Well, I think we had this conversation, if I recall. We may have even engaged in a conversation similar to this around strategies for sellers when the market didn't look as good as it does today. And one of the ways that you can do that is potentially making your house more affordable. And there's strategies around that. So it's not I think to me that's the biggest thing is affordability. And that's why I also, by the way, and this is completely non-data supported, but I also think it's why rates continue to go down because I think that the economy needs them to in order to drive economic activity. And you can't have falling rates and rising appreciation and then decide that you're going to reverse one of those things and the other one is going to be completely fine. Right. That's not the case. So I think we're at the long-term cost of capital. I think capital feels safe. I think rates are going down.
Great.
I don't know. It's. I love these conversations because it just speaks to there's not an easy answer to any of these questions. They're very involved, and they should be talked through with professionals so that you can make a decision about how you're going to engage in real estate. And for the love of Pete, don't read national papers. Talk to experts. Don't, that's clickbait. It is. It is. Excuse me. And if you don't think it is, go back and look up some articles from 2011.
Right.
They were telling you real estate was a terrible investment and you shouldn't buy it. It was actually the exact opposite of what you should do.
Right.
Now, I didn't have any, I had no disposable income at that point, so I could not buy real estate, but I wished I had. And people that did really well.
Yeah. I luckily owned a home at that point.
Very nice.
I bought in December of 2007.
Just you timed it perfectly.
Oh, yeah. It felt really good.
But what's funny about it is all you had to do was wait.
Yeah.
And you waited.
And I did, and I'm so grateful that I did.
Yeah.
And but to your point that you just really need to surround yourself with a lot of information, and what you decide for you and your family has to be unique to you.
Yep.
But where you come into play, where I come into play, where your realtor comes into play, is delivering you expert information for the area that you live in, because that is really important for making big decisions like housing, the type of loan that you take on with your housing, how affordable housing is, how long do you plan on staying in that housing. All of those questions need to be thought over.
And I think also thinking about things that people don't traditionally think about. Is it reasonable for me to think there will be less competition for the same house or more in the future? What do our demographics have to say about that? Are there fewer household formations or less? Are there more people sitting in multifamily that want to get out or less? Are there fewer people moving here or more? I mean, I think those are all reasonable things that provide a data point to look at for consumers as they decide what they're going to do. Is, do I think there will be more or less competition in the future for housing? And I think on that front, it's one of the reasons I feel confident that there will be more. And all of the data points would indicate that. So I think there will be more demand for real estate.
Wow. I hope you're right.
That coupled with interest rates, we're good.
We are looking good for the next 5 years.
Yeah. We'll
be going to Tiffany's monthly.
Yes.
Buying the boats, the vacations, all the things.
Yes. Yeah, I have a fairly bullish outlook on real estate here. I do. And I just want to be clear, that's not everywhere in the country. I'm not saying real estate everywhere is great. I'm saying we have some particularly good fundamentals around real estate here. I'm also not saying that interest rates, may not go up, because they go down like this. So when I say I think they're going down, I do think they're going down like that.
Right.
The current rate environment is I think indicative of that, where they've ticked up and now they're, I think, starting to abate a little bit. But I also think that we have to return to a normal market at some point. I also don't think that means that you're going to be competing with 12 people who are willing to pay $30,000 over ask price for the next 5 years. That isn't what I mean. I don't think our market is healthy right now, and I wouldn't want it to stay that way long term. We may get back to a point where prices are 100% of asking, or God forbid 99% in some cases. We may get back to a point where the average time on the market is 30 or 45 days, as it's traditionally been. It's very important for us to remember that especially the last 12 months has been an extreme outlier in terms of the supply-demand equation here.
Right. Not a normal market.
It's not normal. So, as you see, which you certainly will, prices stabilize and days on market, tick up a little bit, and maybe even inventory available tick up. And maybe you're one of 3 offers, or maybe you're even the only good, solid offer on a property. None of those indicate a market that is bad or out of balance or any of those things. I would want to see those things in our marketplace in the next 12 to 24 months. If we don't, I think we do risk having a long-term unhealthy market. And that gets into a whole nother conversation around what does that mean if that's the case. And there are then, I think, demographic and social issues that come with that as well. And that's a separate conversation.
Maybe we can do an afternoon session with beverages for that one.
Not one that's recorded.
Fair enough. Well, I really appreciate your time, Noah, and your expertise. I really value your opinion, and I think that this information will hopefully be received well and helpful. So
I hope so, and I appreciate you allowing me to talk. I love to do it. So.